What's up? Welcome to another video where we try to beat the S&P. As you know, we have 4 rules here that guide how we trade. We trade in our Roth IRA to avoid short-term capital gains tax. We don't use fancy tech. This Google Sheet is about as fancy as it gets. Rule number 3, we get in the game. This is one thing that's missing from all the other trading videos out there. If our money is not invested in a particular stock, it's going to be invested in the S&P 500 because we're investing largely for retirement, and the S&P 500 returns about 10% every year. So our money's not going to sit on the sidelines. And then rule number 4, twice a week or less. I'm busy, y'all are busy. So let's get into it. Here's the first strategy we're going to look at. We are going to use the RSI. If you don't know what RSI is, it's a leading indicator that looks to see if a stock is overbought or oversold. And so here is an example RSI chart for the stock with ticker RS, which is actually kind of funny. So you'll see right about up here, our stock gets as overbought as it is on this time period. And then down here, it gets as underbought as it is on this time period. The RSI essentially works by looking at the average gains and losses over a 14, 18, whatever week or day period, and seeing, well, here's a formula. So it looks at those and it looks at discrepancies between those to see if a stock has essentially been sold way too quickly or been bought way too quickly. Now, this is just a technical indicator. So with everything, we need to check it. So for example, if a stock's RSI shoots way down, we might say, oh, that stock is oversold. Let's buy it now while it's on sale. But hey, maybe we should do a quick Google on the news and make sure that that company didn't just declare bankruptcy or something like that. Same, especially you could imagine the opposite scenario with biomedical stocks. If it shoots up, well, hey, if they just announced some breakthrough in a drug, their company's valuation really might actually be worth that much now. Tradition and common sense in trading says that an RSI over 70 means the stock is probably overbought and you should expect a decrease in price. An RSI under 30 means the stock is probably oversold and you should expect an increase in price. So we went through 3,478 tickers, and we have some code here that ranked all of them by RSI. And this gave us the 50 tickers with the lowest RSI. And you'll notice this is actually a pretty good number to use. We got real close to 30 here at the last one. So does that mean we should buy all of these? Are all of these oversold? Well, maybe not. And so since the RSI is a leading indicator, I took these 50 tickers and I wanted to evaluate them through a simple SMA cross. SMA stands for simple moving average. I thought this was a good simple way, that's not going to take too much time, just to make sure that the RSI is, to double check what the RSI is telling us to do. And so this is a little ugly, but I just pasted them on here. Gray ones are tickers that we should not buy and we should not evaluate in the future. For example, I think MICR, each share is worth like 1/100 of a cent. That's not useful to trade. That's not going to be a worthwhile investment. It's just it's basically worthless. But I went through the rest of them and I color-coded them here. The SMA, if you don't know, is just simple moving average. You can also use an exponential moving average. You see this with MACD a lot of the time. This is a lagging indicator because it just looks at the average over a past period of price. And I'm using a 13-week for our short moving average and the 40-week for our long one. How this indicator works is a moving average cross. So if the moving average is cross, that's going to be a buy or a sell signal. If the short average jumps and crosses over the long one, like you see right here, that means the stock is moving up more than it has been in the past and we probably ought to buy it. Whereas if it crosses underneath, that's our sell indicator. Hey, the stock it's losing value quicker than it has in the past. Neither of these indicators are perfect, but what we're testing right now is if we combine them, or if we use this one to filter what the RSI tells us, how will we fare against the S&P 500? If we don't match it over a period of time, this is probably not a worthwhile strategy. You should probably just buy SPY or VOO. So what tickers did this tell us to buy? Well, I have an example here of each one. So PNRG. PNRG, let's look for it here. PNRG has an RSI of 27.9. And when we look at it here, we see that our moving average is dancing, our short is dancing up and over the long, and it looks like our short moving average is about to cross above the long one, which is about to be a buy indicator. So this is a good one. This moving average cross says, yeah, RSI told you some good information probably. TDC, here's one that we ought to hesitate on. So as you can see, this isn't necessarily any bad information, but what I did is when you look at TDC over the long term, that stock's, it's not having a good time. So it's just going down, 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 down. And I looked at some news for Teradata Corporation, this company is too, and they're in a period of decline. And so this is a question for you. How much do you want to stick with the indicator and how much do you want to look at other fundamentals? I chose to hold off on TDC for this reason. That's why it's a yellow flag here. Here's PNRG, for example. Over the long term, they're doing all right. You looked at some fundamentals, they're doing fine. One thing that RSI said yes buy, that this moving average cross said not to buy, is ticker RE. And we know we shouldn't buy it because our moving average is shooting way down below our long moving average. And it doesn't look like these are about to come together anytime soon. So for this reason, I chose to hold off. It's useful to use two different tickers because the Venn diagram of what they are going to suggest is smaller than what each one will suggest. And by comparing with different sources of input, you can hopefully get some better guidance. So these are the tickers we're going to buy. They're scattered here, but we've got 4, 5, 6, 7, 8, 9, 10 of them. And so I know and you know that it's important to diversify and not put all of our eggs in one basket. So we're probably going to put, we're going to put just 3% of our portfolio in each of these stocks. Just 3%. That's not a lot at all. This gives us some room so that we can buy more tickers later next week before the sell signals for these come around. In a future video, we'll talk about what the sell signals are. So I'm going to put in those buys. I'll log on a spreadsheet exactly what price value purchase them at. We'll see how they do. And then, like I said, in the future, we'll talk about what our sell signal for these is going to be.